All right, good afternoon, everyone. Obviously, some really exciting equity investments there that can be made. We're going a little bit more vanilla with some debt investing now. And obviously, look, private credit's been growing at a pretty rapid clip in Australia in recent years, and we've been there for 8.5 years in the sector. And most of the team who are here today are out of the banking sector. So I think we've seen some interesting press in private credit. I think there's been a really strong focus on returns, and now we're starting to see the shift into what risks you're actually taking to generate the return, which we're very happy about because as a team coming out of the banking sector, we are used to measuring risk, quantifying it, and obviously disclosing it to our investors. So as a business, we started 8.5 years ago. My background, I was at Macquarie Bank for 11 years before rolling out to start this business in a joint venture with Aura Group. From a standing start, we're now managing over $1.1 billion in assets. Our wholesale fund has returned 9.63% per annum since inception on a compounding basis. And while doing that, we've retained a $1 NAV. We've also been the top performing fund in APAC for 22, 23 and 24. And what they take into account there is not just your outright return, but also your Sharpe ratio, growth, etc. Back to the team. So there's a team of 7 of us within Aura Private Credit and over 61 years of experience there. So what's the thesis? And look, I think we heard a little bit about this with the FC presentation earlier. Australia's in a really nascent stage with private credit. So if you look at Europe and the US, they're markets that are very mature. So over 91% of lending is done in private markets in the US, so 9% in the banking sector. 65% in Europe is done privately, whereas Australia, 9% of lending is done in the private market. So you can see when you look at those global peers, we've got a very long way to run in the Aussie market. The other point to note, and this was something that was really fundamental when we started up the business, is the funding gap. So post-GFC, Australian businesses in that SME to mid-market corporate space have had reduced availability of capital. That's a real problem. The SME market employs over 70% of our workforce, and as seen during COVID, it's really the backbone of the economy. So what we're looking to do is raise capital and deploy that into Australian business lending, and we do that through what we see as best-of-breed Australian business lenders. We've screened a significant number, coming up on 200, and we're funding 8. Now, our core objective as a team is to preserve capital. So, unlike some of the VC investments, which will provide you a 10x potentially, we are there to have stability of your capital. That's our core objective, and then provide an exceptionally strong risk-adjusted return. And in doing so, we've returned over 9.66% this year and 9.63% with no capital volatility since inception. And one thing I'll note is we do impairment test the portfolio on a monthly basis, and that is audited by EY. So we adhere to the accounting standards on valuation. Now, one thing we didn't do, or we didn't set out to do when we launched the vehicle, the wholesale vehicle, was to compare ourselves to equity markets. But fortunately, our performance has been strong enough that we've actually exceeded equity markets for the majority of our life. So if you look at the ASX 200 on an accumulation basis, we've basically matched the returns there since inception with no volatility. Now, the other proxy that you'd be looking at within your portfolios is either fixed income, general fixed income markets, or your high yield index. And as you can see from when COVID kicked in back in February 2020, fixed income markets, particularly in that high yield space, came back significantly and have not really recovered. We've been able to sort of truck through that. Now, the next thing is that consistency of return. So what investors should look at with our asset is a vehicle where your objective is limited movement in your capital base and then that monthly income. So we see our assets as being pivotal or a real core for particularly superannuation funds or retirees who are looking at income within their portfolio. Or for younger investors who are looking at building out their portfolio, this is a real growth engine where they're able to fund capital calls in VC funds as an example. Now, one key differentiating factor in what we do, we're very much focused on diversification. So it's a spreading of risk across a broad number of industries, geographies, and loan types within our portfolio. So we've currently got exposure to over 13,900 loans within the portfolio. So if you're looking at a lot of other private credit providers out there, they'll have fairly lumpy portfolios. What we're very much focused on is spreading that risk. So one of the biggest risks we see in all credit markets is sort of deep, prolonged recessions and the impacts that will have on a business's cash flow. When you spread that risk over a broad variety of industries, geographies and loans, you mitigate a lot of those risks. Now, the other thing we don't do is property development. You'll see there we do have exposure to the construction sector. So our industry splits are based on ANZIC codes, so that's the ABS codes. And if you look at construction, it's a very broad category. So it'll take anything from your local plumber through to lend lease. What we do with the construction lending that we're completing is predominantly property backed, so that's a completed property, not under construction as your security. 95% of our construction exposure is property backed. Now, the other thing we don't do is unsecured lending. So we have some form of security on our lending. So that'll be general security agreements, personal guarantees, property, assets, invoices, livestock. We do legal disbursement funding also. We're very much agnostic on the loan type. So we're currently funding 8 lenders in market. So as I said earlier, we've screened over 200 and we've funded 8. So a circa 4% hit rate on what we'll fund. We're very selective, and as I said at the front end, we are not here to provide you a teens plus return. We're here to provide a 9 to 12% return, and our target is to provide capital stability there. Now, we've got a very robust analysis of lenders. We look at it from 2 main lenses. One, what characteristics does that business have? How well capitalised they are? What's board composition? The players, so the people within that business, are they well qualified? Do they have a credit background? What has their track record been like? And then we look at a more fundamental credit analysis, looking at their risk policies, procedures, and we build a lot of portfolio parameters to protect capital within a structure. So one of the key benefits of warehouse financing, which is what we get involved in, is that the lender will always have some skin in the game. So that'll be their NIM, their fees, their equity capital at risk to a level. Now, one key differentiator with respect to warehouse financing versus direct lending is you do not get that layer of protection. So you'll see direct lenders out there who will deliver you a higher return, but they are missing that critical layer of protection that we have in our warehouse facilities. And then looking at risk, so once again, taking that bank lens, we've actually engaged for $250,000 a year. We've engaged an external party to assess each of the 13,900 loans in our portfolio from a default perspective. From that point, we run over 1 million simulations on a monthly basis across those loans and derive a loss given default. So what that comes out to is within the Aura Private Credit Income Fund, an investor could expect a negative return in 7 in every 1,000 years. Now, to put that into some context, in equity markets, an investor would expect a negative return in 1 in every 4 years. So just looking at that volatility measure, it's fairly different. And if you bring that back to a public market sphere, coming out at a current BB level, and look, as a team, we've got an objective to push that towards a BBB internally. So looking at it from a risk-adjusted returns basis, we're getting outsized returns when you compare that to public markets with monthly liquidity, monthly income. So a key differentiator in what we do. So if you have any questions or if you'd like to invest, please get in contact with us. You can contact us through the Wholesale Investor platform or directly with our team members. So thank you very much for your time. Have a great afternoon.